Good morning, everyone. Thank you for your time. The purpose of this review is to walk you through our performance with a specific focus on demonstrating our firm's unwavering control over our core operations.
To begin, let's frame the sheer scale of our responsibility. We are managing a fleet with an original cost of $22.5 billion. Our success, as you know, hinges entirely on our ability to effectively manage this immense asset base. Our position as the world's largest gives us a significant competitive advantage. This integrated network of nearly 1,800 locations provides operational efficiencies and a market reach that are, frankly, unmatched in our industry. So let's start with our first key area of focus, how we maximize the return on that massive fleet. This all comes down to a metric we live and breathe: fleet productivity. Now, to be clear, fleet productivity isn't about raising prices. It is the purest measure of our operational efficiency. It tells us how effectively we're keeping our equipment on rent and generating revenue. It's a direct reflection of how well we're running the business at a fundamental level. And here's how we do it. We rigorously apply lean management principles to eliminate waste. We are constantly optimizing logistics for deliveries and pickups. We've shortened our repair and maintenance cycles to improve uptime, and our sales teams are laser-focused on cross-selling higher-margin specialty equipment. Every one of these actions is designed to squeeze more value from our assets. Okay, let's now turn to the other side of the balance sheet, the costs associated with our growth. Specifically, I want to address depreciation because it tells a very important story about our long-term strategy. As you can see, the depreciation expense in our specialty segment saw a significant year-over-year increase from roughly $500 million to $650 million. Now, an increase of that magnitude naturally raises a question. Is this a cost overrun? The answer is no. This was not only planned, it was a strategic imperative. This increase is a direct, calculated result of our investment in growth, most notably the successful acquisition and integration of Yak, which has made us a dominant player in the high-margin surface protection market. So I want to be very clear on this point. This is not an uncontrolled expense. It is the calculated cost of capturing a higher-margin market. We are deliberately investing through the P&L to secure a more profitable future.
This brings me to the core of our strategy. The best way to think about our company is as a machine with two distinct but interconnected engines, each serving a critical purpose.
On one side, we have general rentals. This is our foundation. It's the stable, high-volume bedrock of the company. On the other side, we have specialty rentals. This is our future. It's the high-growth, high-margin engine that is driving our long-term value creation. And the numbers for 2025 bear this out. General Rentals remains our revenue leader at $11 billion, providing stable, predictable growth. But look at specialty. It's growing at over 13%. More importantly, its rental gross margin is over 800 basis points higher. That margin differential is the key to our entire strategy.
Now let's drill down into the margin changes, because this truly demonstrates our level of control. In general rentals, the slight margin decline was driven by external factors, inflationary pressures on labor and transport. In specialty, however, the margin decline was driven by a deliberate internal decision, the increased depreciation from the growth investments we just discussed. We know exactly what's driving these numbers in each segment. And this is how the two engines work together. The massive, stable cash flow from general rentals provides the fuel for our strategic, high-margin expansion in the specialty business. It is a balanced, deliberate, and self-funding strategy.
So with that framework in mind, let's look ahead to the path for 2026 and how we will continue to maintain control and drive value.
The ultimate proof of our operational health is cash flow. In 2025, we generated $5.19 billion in cash from operations. This robust cash generation gives us tremendous flexibility to continue funding our growth, managing our balance sheet, and returning capital to shareholders.
But we are not resting on our laurels. We are already executing a detailed cost reduction plan for 2026. This initiative is designed to further enhance our efficiency and proactively protect the very margins we've worked so hard to build.
In conclusion, I hope we've demonstrated our profound internal control over our business model and our costs. The key question for us as a management team is no longer about our internal discipline. It is about how we leverage this well-controlled operational machine to navigate the external pressures that we all see coming, from interest rates to market cycles. And we are confident in our ability to do so.
Thank you.